What's up, everybody? Welcome back to the Kansas City Commercial Real Estate Market Pulse. I'm your host, Logan Freeman. Today, we're joined by August Biniaz. He's the co-founder and CIO of CPI Capital, where he's helped to close more than $225 million in multifamily and build-to-rent assets while becoming a LinkedIn top voice and a leading voice in real estate. What's up, August? How you doing, man?
How you doing, Logan? Long time, man. I'm glad that we got to connect, and especially on this setting, hopefully add value to your audience here.
Yeah, I know you will, my friend. So tell me about the LinkedIn Top Voice. How'd that come about?
Yeah, LinkedIn Top Voice is invitation only. So
Yeah.
I was creating a lot of great content on there, just like as you do. And they reached out. There was an opportunity to become a LinkedIn Top Voice, and obviously we took that shot. And yeah, been a LinkedIn Top Voice now, I believe, for 4 years.
Absolutely, man. Well, I had the badge for a bit, but I don't know why I got it taken away. So I'm a little bit jealous over here. No, I'm just kidding. But honestly, you absolutely have been committed to this platform and to putting out great content for a very long time. And we host this podcast for one simple reason: clarity beats noise. And we're going to get to a lot of clarity here together. But I do want to give a shout out to some folks. We've already got questions rolling in. Mariah B., Jacob Graubager, Joy, Gabe Einhorn, Matt Fairclough, Brian Ferguson. If you guys have questions, drop them in. We'll make sure to get to them. If you guys need any support in commercial real estate, transactions, development in the Kansas, Missouri, Nebraska, Iowa, Oklahoma, Arkansas markets, I've added a few now. Here's our team, and we're growing rapidly. Do reach out to us. But our guest today, like I said, is the co-founder and CIO of CPI Capital. August is leading investment strategy, acquisitions, and asset management. He's got over 15 years of real estate experience, closing over $225 million in multifamily and BTR assets. That's a good trend to be on. He's also the host of the Real Estate Investing Demystified podcast, and he's a recognized voice in commercial real estate, man. So glad that you are here. Thank you for dropping on to the show today and being here. Now, we have a question we're just going to start off with, okay? So my question is from Jacob. He says, my question is, how many sleepless nights, spreadsheets does it, and gray hair does it take to get from one property to 225 million in assets?
That's a great question. I mean, on a regular kind of time basis through the real estate journey, that happens no matter what. But imagine starting the firm in 2019 and going through a few cycles already over the last few years. Usually it takes around 8 to 10 years to go through a real estate cycle. But I would say from 2019, where we were already in mania stage of the real estate cycle, the market had gone on a bull run starting from post 08. By 2011, we were at the bottom of the market, and market started ticking up in 2011. And by 2019, we were already at the top of the market, and you could feel that there was cracks forming within the commercial real estate space and real estate in general, not just commercial real estate. So you could tell that you were in kind of that mania phase. But soon after, cataclysmic event, COVID came in and threw a wrench in all of that and resetted the whole world and economy and interest rates and so on, and inflation. So prior to inflation, I mean, they had to reduce rates to keep the economy going and making sure it doesn't collapse. But it resulted in a lot of cheap debt out there, and it resulted in a lot of acquisition teams and development teams building a lot of deals and acquiring a lot of deals, and they were comfortable putting deals on high octane date from 2011 to 2019. So that's exactly what everybody did in 2020, 2021, 2022, which caused a lot of distress when those loans started maturing. And then the Fed had to deal with inflation, which was caused as a result of so much money printing. So they had to increase rates in such a fast pace, 11 consecutive times from 2020 to 2022 approximately. And it's been a few cycles, and now we're again in a new phase. It seemed like things were calming down a bit. The 10-year Treasury was around 400 basis points, and then we have a war in Middle East, the Iran war, which is causing some new issues, which has increased the 10-year to 430 basis points, so 4.3. So yeah, gray hairs, a lot of sleepless nights for sure. Absolutely, over the last few years.
Yeah, most definitely. And quick shout out to Anil for being here. He's coming from the commercial real estate, multifamily, and background. If you got a question, Anil, drop it down in there for us as well. Matt Faircloth is saying scaling in real estate is rarely a straight line. And I want to talk about this. It's usually built through repetition, relationships, and learning how deals actually get financed and executed. So we've got up here on the screen from syndications to institutional capital. I'm guessing that wasn't a straight line, my friend. And we were connected back in 2019 and 2020, doing podcasts together, watching each other scale and grow, make mistakes, learn. Talk to us about that line being either linear or was it more up and down? How have you guys navigated that?
Yeah, I would say that there are really two lines for growth that exist in real estate. One is the specialist line, where you're someone who is a master of their craft in what is it that they do. If it's multifamily, if it's development, if it's short-term rental, no matter what space you're in within the commercial real estate or real estate in general, there is always a path of progress that line for growth, because you're expanding the business model that you're continuing to grow. So, for example, a value-add investor, multifamily value-add investors who could continue growing their portfolio and their footprint in a certain market, and some firms have done tremendously well. Same thing in merchant home building, for example. There are ways to scale in that way, and that's the most common way. Now, the private equity kind of aspect of it expedites that process. So, for example, CPI, our firm, when we started out, the plan wasn't to go and become a specialist when it comes to one asset class as far as daily, the day-to-day operations and what have you. It was more building a platform which allows us to bring deals for our investors, retail and institutional, and through the process, have third party manage our properties. So we don't want to go in the business of managing properties, but becoming experts in analyzing deals, creating deal flow, and overseeing the property level management. That was kind of the idea. And we didn't want to be a specialist in one market, because we also looked at other firms who had done tremendously well historically when it came to multifamily or other asset classes. And when you are the old kind of saying of putting all your eggs in one basket, when there is a downturn, for example, a lot of firm did incredibly well in Phoenix over the years, and a Canadian firm as well. But when a downturn came, because most of their deals were in Phoenix, they lost over $300 million of LP equity, and they had to restructure many of their deals and lost to many of their deals. So we wanted to be more diversified when it came not only to asset classes, but also regions as well. So the line for growth is at times, obviously there's ebbs and flows when it comes to growth, but it's also, you also have to take an inner look at the company itself. Initially, the plan was to be a very multifamily value add focus in one market, but soon after we realized that we rather be a more diversified platform than just one city, one type of asset class, one business model.
I want to double click on that real quick, because we had on Ari Rostigar, who's the Oracle of Austin, Texas. And he said something very similar last Friday, which was, hey, I'm picking markets and I'm picking operators, and that is how I'm working through this process, right? And so it's really important on the relationship side. Now, you mentioned at the beginning of the show, August, 2019, top of the cycle. Then, can you believe that 2020 was 6 years ago? That's wild to think about, right? I know your family has grown. You look a little different with you got your hair, and you've always had the beautiful beard, but hair looks different. That was 6 years ago, man. Your family's grown to, you have 2 kiddos now?
That's right. Yeah, 2 kids under 3 currently. So yeah, man, a lot of changes, definitely.
Yeah, most definitely. But let's get a read on where you guys are seeing, the real estate markets today, right? Like what does that look like for you? You feeling like this is an opportunity to really get in there and buy some properties, or with that 10-year treasury, is that pushing back deal flow? I'd love to hear your take on that.
Yeah, so commercial real estate is very sensitive to interest rates. So currently we do have volatility in the interest rate environment, and a lot of commercial loans are are coupled to the 10-year treasury because it's an organic number that the market sets. So a lot of loans are there. So yeah, you've seen the 10-year treasury move over the past few months because of the Iran war. But yeah, I mean, commercial real estate is currently in a bust cycle, multifamily, other asset classes, mainly as a result of oversupply and a lot of acquisitions taking place as compressed cap rates. And today, we have, because of oversupply, you have a downward effect on rents. Vacancies have increased, concessions have increased. So we're definitely in the bust cycle of real estate. I wouldn't say I'm a real estate maximalist where I always say you should always be buying in real estate. Some experts, that's what they say, or what have you. So I do believe there are times throughout the real estate cycles that you need to sit on the sideline. From 2022 to 2024, we literally sat on the sideline burning cash and not doing a single deal. The first deal we did was in June 2024 when we came back into the market, and we put low leverage agency debt, interest only agency debt for fixed for 5 years on that deal, which was a great decision to make. But today where we're at, there's been correction in prices in a lot of growth cities like your DFWs, your Austins, your Phoenix, Tampa. There's something between 20 to 40% correction in prices because in commercial real estate, the price is not only set by comparables, but the price is set by the prevailing cap rate. So you could be doing, you could buy a property at great basis. You could be, having decent debt on there. You could be executing the business plan perfectly, but you can't control what the neighborhood prevailing cap rate is or that market cap rate. So you could have bought something at a 5 cap, and today that cap rate is 5.5 or 6, and that erodes away so much of the property's value, which is totally out of your control. So as general partners, that's why the GP makes a decision on when the deal should be divested, because if you go by emotions, same way with public equities, if you're emotional and you can go online and press the button, you end up buying at the high point and selling at a low point. So as GPs, one of our fiduciary jobs is to understand that cap rates are, do move, and we have to stay focused on the business plans and our thesis and try to exit when it makes sense to exit. But that's just part of the nature of the beast. So I would say today we are definitely in a bust cycle of real estate. I really believe that as long as you can put low leverage agency debt on deals, and as long as the deals make sense, it's a great time to buy. But again, some real estate maximalists always say it's a great time to buy, but today truly is a great time to buy.
Yeah, well, we got a lot of listeners that just joined us. So August Biniaz, CPI Capital, is breaking down the real estate markets. Hey, tell us a little bit about the build-to-rent market right now, because it's been in the news all over the place, right? Legislation coming down on maybe not letting institutional owners own real estate or build new real estate. What's the state of that right now in the build-to-rent market?
Yeah, build-to-rent is, just to touch on it for people who are not familiar, but is somewhat of a newer asset class under the commercial real estate umbrella. It falls under multifamily, but the business model is when groups, investors, institutions go out there, buy a piece of land, and build purpose-built rental communities, either single-family, duplex, triplex, or quads. And the business model is to build a community of rental, not for sale product, but for rent product. And the business plan could be a bit expanded as well. You could build it, stabilize it, refi and hold it long term, or you could pre-sell the units, or you could stabilize then sell. So there's a lot of different exit strategy within the model, but the model overall is the development of purpose-built rental communities. And the asset class has done tremendously well. Now the Trump administration had a battle with institutions purchasing single-family homes. This is different than BTR. This is scatter sites. So quick background story about scatter site purchasing by institutions. The largest institution owning scattered single-family homes in the U.S. is Invitation Homes. And Invitation's home backstory is in post-GFC, real estate prices for single-family homes in the U.S. had gone up every single year since World War II, all the way up to 2008. It had gone up every single year single family home prices had. But nationwide in 2008, single family home prices dropped 30%. So large institutions like Blackstone, which is the largest private equity firm in the world, their model was to come in and buy as many scattered single family homes as possible, because they knew that this is just a market cycle. The market would turn and they're going to come back and sell these at great profit. And that's exactly what they did. They partnered with a group out of the UK. They established Invitation Homes, and they went out there and bought tens of thousands of homes, eventually buying 75,000 homes altogether, scattered sites, and took the company public. Blackstone exited that, but Invitation Homes still there, publicly traded company. So, but the issue there is when you are a consumer, somebody who wants to get into becoming a homeowner, you're going out there to buy a home. Now you're competing with an institution. And I really, as a real estate person, I really believe that institutions shouldn't be competing in single family, because even though I am a free market, Milton Freeman, free market capitalist type of person as well, I just feel that institutions buying single families is an unfair advantage they have, and they could push up prices. So that was the battle that the Trump administration had with institutions buying single family home, and they created a bill, and they took the bill for it to be bipartisan, and they passed it on to Elizabeth Warren. And when Elizabeth Warren's team got their hand on the bill, which was supposed to be banning institutions from owning scattered site single family homes, they included BTR in there as well. They included institutions going and buying land, building home, and for the rental purpose, even though that adds to supply. It's not somebody competing with institutions buying homes against regular people trying to get a home for themselves and their family. So, but it actually passed the Senate, and it was that bill with Elizabeth Warren, and which was bipartisan. But the housing lobby got involved and got the BTR to be removed from the bill, and I believe the bill has now passed the House, which does not include restrictions on actual purpose-built rental development, but it does still include restrictions on single-family acquisition. So anybody who owns single-family, they're grandfathered in, but if they want to go buy any more single-family scattered sites, they are restricted to a certain number. I think is 50 homes or above. They will be taxed differently, and there will be disadvantages in doing so. There'll be restrictions. So that's a quick high level of the bill.
Thank you for breaking that down for us. I appreciate that. I want to give a shout out to Gail, who showed up. She said, "Good one, August." I know he's dropping a bunch of good knowledge for us here today. Thank you, Gail, for being here. We do have a listener question come in. A lot of people wait until they make it to start building a brand, but how important was visibility and thought leadership in helping you to scale to where you're at now?
Yeah, wow, this is a great question. The person must be sophisticated themselves about this. So I personally come from the home building business. I was a home builder for close to a decade before I was lucky enough to co-found CPI with a couple of great partners. And in my home building business, it was to create leads and make connection. It was really a grind for me to achieve that over the years, and only in the later parts of my business, so I would get a lot of calls and inquiries about building homes for people, because I had never really worked on my brand around my company. My focus was more about the work I was doing. Yeah. So it was very difficult to kind of get leads and advertisement and what have you. So when I did, when we did start CPI, my recommendation to the team was we need to put extensive focus on building a brand around the company, not only around the company, but also the executive team members as well, because that's going to allow us to be able to have investor leads. That's going to allow us to have potential joint venture partners who bring us deals that we can joint venture on. That's going to allow brokers in the industry to know us. So one of the things we did early on was we started our own podcast that you mentioned, Real Estate Investing Demystified, interviewing great speakers and guests such as yourself, Logan. You've been on our podcast actually a couple times.
Yeah.
So that was a way to build a brand around that. And then also for ourselves, speaking on other people's podcasts, being, very active on social media, going to conferences, in today's world with social media and other things, if you're not being seen, you don't really exist, right? The days of, somebody coming and investing tens of millions of dollars in your company because they met you at some event doesn't exist. People want to see that brand recognition. They want to see that social proof. They want to see you as an expert in your space. And it does do that. If you are, eating, living, breathing the business, it allows you to learn. We've had over 400 guests on our podcast over the last 6 years, and we've learned so many different new business models within the real estate world, some things that we didn't know even existed previously. If it's creating posts and being active on social media, again, you have to go out there and learn and be updated on what's happening with the market to be able to create content on your social media. So it keeps you at the top of your game when you are creating content. And then the byproduct of that is that there's a brand built around you individually and your company, which creates leads on the equity side, investors who want to partner with you. Investors sometimes get on a call and they're surprised because they're like, hey, I feel like I know you already because I've seen so many of your videos and different content about you. So extremely important, highly recommended in any industry. It doesn't even have to be real estate. If any industry you're in, you should be the expert voice in that space. If you're a roofer, you should be making YouTube videos about, how to do roofs and the mistakes to make when you're hiring a roof contractor. You should have a YouTube channel. Like it's a must, and it'll really give you that edge that you need to scale your business.
Yeah, well said. And what I will tell you, August is a wonderful follow on LinkedIn and the other platforms. He is unfiltered himself 100% of the time. So I've always respected that about you, my friend. So kudos on that front. All right. So we talked a little bit about the multifamily cycle and being in a bust. Okay. Give me your outlook for next couple years. Everybody's talking about the looming, maturity wall of debt that is coming due. I think it's happening. And I think those deals are absolutely happening. I was following Mark Allen, who's down in the Dallas-Fort Worth area, multifamily broker, active on LinkedIn. He was saying a couple of weeks ago, there was 27 call for offers for multifamily properties in Dallas-Fort Worth. What is that what you're seeing out there in the marketplace? Is that the opportunity right now?
Yeah, we're in two different markets. We're in Florida and Texas. In Florida, we're hyper focused on Tampa, and in Texas, we're focused on San Antonio and DFW. So they're all vastly different markets, interestingly enough, for multifamily BTR as well. But on the multifamily side, the markets are performing differently. So in Tampa, for example, there isn't a lot of deals that are transacting. A lot of deals are coming online, but the last data that we had, 80% of deals that come online, they actually don't end up trading. If you compare that to historical numbers, and I was talking to some of the top brokers in Tampa, that number is around 15%. 15% of deals that come to market don't end up transacting. In Tampa Bay, 80% of deals that come to market don't transact either if it's a situation that the seller was just testing the market, if it's a situation that the seller is dealing with their lender and they're potentially in debt distress, and they're looking to showcase their lender that, hey, this is what our property is worth today. If it's a situation that they are looking to exit but couldn't get the price they wanted, for whatever the reason is, a lot of deals are not transacting. So it's very difficult to not only make deals pencil, but hoping to get your hands on it, because we follow up on deals that do match our buy box, which is over 100 units, less than 50 million, your standard middle market in multifamily. We follow deals that come into our pipeline, which we take a stab at when it comes to LOI and make it to the best and final. And we see, hey, what happened to the deal? Did it ever trade? How much did it trade for? So a lot of deals are not trading. So that's the situation in Tampa. Tampa has also had issues with oversupply and rent compression and concessions as well. So that's more on the core plus. I would say on the value add side, it's still pretty decent when it comes to occupancy and rent growth. Rent growth has been somewhat flat, maybe a bit positive in Tampa. So that's on the Tampa side. We have seen some REOs, distressed deals, which is owned by the lender or is in the process of being owned by the lender, or a lender and the seller are working together. Some of the deals, I would say probably around 10 to 20% of the deals that are coming into our inbox have some kind of a debt distress issue. Now in San Antonio, that's much different. So in San Antonio, you've had a lot more supply come online, and you have the rents have compressed much more, so rents are negative in most cases in San Antonio, and the hyper supply has resulted in occupancy sitting below 90%, and a lot of concessions. So San Antonio is going through some difficult time, but San Antonio also has great absorption as well. So a lot of those units that came online have been absorbed. And another thing about difference between San Antonio and Tampa, even though on the surface San Antonio sounds more distressed than Tampa does, but in one very important side that San Antonio is less distressed than Tampa is that the tenants in San Antonio are less rent burdened than tenants in Tampa. For example, when we look at the median household income for the market that we are looking to acquire a deal, the tenant, when you compare what the annual rent is going to be to the annual income, the tenants are spending 20 to 25% of their annual income on rent, whereas if you compare the same thing for Tampa, it's close to 40%. Now, it's important to note Tampa has the life-work balance and proximity to beaches, so more people want to be there than, for example, San Antonio. But San Antonio has a lot of jobs. It has a lot of growth. City of 2.9 million people. It's going to take over Philadelphia as the sixth most populated cities in the U.S. Currently seventh. So those are some high level. DFW, I mean, it's a beast, right? DFW by 2050 is looking to be 15 million people. It's the amalgamation of two cities. So when you do have two near cities kind of amalgamating together, it results in this huge population of close to 8 million people in DFW. They're saying that a similar thing is going to happen in San Antonio and Austin as well, as they amalgamate, and you have New Braunfels and other cities along the way growing as well, turning it into one huge metro. So it's interesting to watch that. But yeah, I mean, each market is his own, going through his own cycles. But overall, yes, definitely we are in a bust cycle. Some markets have a better long-term growth projections than other markets do. But we love those three markets that we're in.
Well, August, it's apparent that you know your markets, my friend, and what's going on in them. So I appreciate you dropping all of that specific data. You know, when people answer questions specifically with data and not adjectives, I know they're active and they're doing their homework. So that's awesome, man. Thank you for dropping that knowledge. I also just say for Texas in general, with me being involved in a lot of the data center work here in the Midwest, that's a huge boom for Texas in general. And so I foresee that continuing to be massively important for housing and rental properties in that area. Now, the one thing that we didn't talk about was, yes, some of these were in hyper supply, but starts dramatically went down the last couple of years, right? So this isn't a forever situation, right? So what are you tracking in regards to new supply coming online once this properties that have been supplied? And that's a tough one for those developers that hit it in the market where it was oversupplied, but it sure does seem like it might be a big tailwind for the marketplace here as starts are way down. Is that correct?
Absolutely, yeah. So the development in the U.S. over the last half a century has gone through those ebbs and flows where when debt becomes cheap and population growths increase in certain markets, you have developers coming in and overbuilding in some cases. But that's a great thing that the U.S. has. For example, Canada doesn't have that. You never have issues with oversupply when it comes to rental housing because of so many bureaucracy issues and city hall and government interventions with rent control and what have you. But the U.S. with the free market it has, it really, especially Texas and Florida, you do have oversupply that comes online and developers building lots. So yes, so new starts have basically, if you look at a graph on new starts, they've fallen off a cliff. This is not a convoluted topic at all. If you look at it, even not as an expert, if you look at a developer's view of the market, when the market is in need of supply, developer and the debt prices are reasonable or cheap, developers come out there, buy land, and start building. But their project usually takes at least 2 to 4 years to complete. So by the time the project is completed, they're in a different market in most cases. Sometimes the market still has need for that supply, but for the market we're currently in, a lot of those developers started building in 2020, 2021, and 2022. So their projects are either completed or near completion, and there's oversupply. And supply is something that you can easily see in the space. So a lot of developers now are on the sideline, including a lot of the merchant builders. To add to that, when I brought up the merchant builder topic, merchant builders, the D.R. Hortons, the Lennars, the Pulte Homes, they learned from the mistakes their counterparts had made in '08 as well, which a lot of companies went bankrupt. They are very careful when it comes to oversupply. D.R. Horton, we're looking at a couple deals through D.R. Horton, and their business model was to stabilize and the property and then sell. But now they're doing forward purchase contracts with most of their BTR projects. So yeah, I mean, that's again going back to my thesis where it's a great time to buy is because you're not having a lot of construction, a lot of starts happening, and that data is very easily tracked through city websites and what have you to see how many applications are going in. So
Yep.
yeah,
Major tailwind for the industry. So it's all about understanding the different markets and where they're at in regards to their specific locations on that chart that we just showcased, hyper supply expansion, where you're at. Okay. So, I do have a question in from a listener, and this is all about kind of small investor, scalable operator, right? And, they just asked, at what point does someone start being just an investor chasing deals and actually becoming an operator building a scalable business, right? Like that's the people who are still in the industry that were back in 2019 and before. Those are operators that have been scaling businesses, right? Instead of just investors doing a deal or so in a group of individuals. When did that happen for you guys and start building this scalable business? Was there like a moment that you said, oh my gosh, like we got something here? Or was it from the get-go, we had a vision and we were working on the daily rocks and quarterly rocks to make sure that was happening?
Yeah, exactly. When I learned a lot. We all of our executive team members come from real estate backgrounds, and they've been in real estate for combined for many decades. So when we co-founded CPI, the vision and the mandate from day one was to build an institution, and that was kind of our viewpoint. So we knew that we had to work hard and build the divisions of the company when it came to investor relations, which handles the equity side of the business, when it came to acquisitions, when it handles the analysis, the broker relationships, and so on, and then the asset management division, which executes the business plan. So we knew that we had to build those pillars of the company for this to be a fully functioning real estate private equity firm. But going back to the viewer or listener's question, as far as when should that timing come up for somebody who invests in real estate, maybe they have a certain allocation in real estate, maybe they are buying small multi, maybe they're building single family homes, maybe they are doing short-term rentals. At what point do you look at yourself and say, hey, I'm looking to build something great, or start a firm or build an institution? That really goes back to you personally and your vision. Is your vision to, and I give the same advice to a lot of younger people that I chat with, and they talk about where they want to be in life and what they want to do. And a lot of times I tell them that you have to look inwards and say, ask yourself, is that where you really want to be? So if you are an investor who's making decent money building a couple of homes a year, or owning a portfolio of short-term rentals, or owning a few small multis, that's great. That's great money, and you can live a great, comfortable life. As soon as you go into building an institution, now you're looking at least a decade of full-time work with a lot of moving parts and a high chance for failure. Is that where you see yourself and dedicating the next 10 years of your life to build something? And that doesn't go away from there. You still have to be involved and have a team that works underneath you. So does that align with where you want to be? And if it does, all the power to you. Be focused and partner with a couple of, find a great partner to partner with and build something great. And subliminally, Logan mentioned Quarterly Rock. So the book Traction by Gino Wickman, which allows you to, scale and grow a company. So take that approach and build something huge, but understand that there is a lot of sacrifice and potential failure that goes there into that. And there is a survivor fallacy when you see a lot of successful teams, and you're like, oh, they've done it, I can do it too. But you don't see the 99% that failed and couldn't make it either. So if you really have the conviction and you really have the insight to build something great, all the power to you, and you should 100% do it.
Love that response. Appreciate that, August. Getting over to my favorite section of the show today. We're going to get on to the quick takes. You ready?
Yeah, ready. Let's do it.
All right, man. Favorite book and podcast?
So I would say favorite book, I'm reading a book on Tremel Crow, who is the founder of the Crow, the largest developer in the US. So it's an interesting book and a lot of stories. So I definitely recommend that book, the Tremel Crow book. Yeah. And then podcast, I mean, it's pretty diverse podcast. My wife keeps telling me about the Desk of the CEO podcast that she hears things about. So that's an interesting one. Commercial real estate, aside from Logan's podcast, that you can ask questions live on there, which other podcasts don't prefer. I would say the Gray Capital podcast is a great one. Spencer Gray, he does a tremendous job there and has a lot of data on there. So that's another one I follow.
Man, he's just nerding out with all his AI and data stuff. So yeah, that's good for Spencer. I know him pretty well. So good to shout out. That reminds me, I should probably call Spencer, have him on the show. Thank you, August. I appreciate that.
Absolutely.
All right. What about a habit that's had the biggest impact on your success?
Rather than, I guess a habit is more of what not to do. I mean, honestly, actually having habits and taking small steps is the greatest way to achievement. Nobody wakes up in the morning and is a professional athlete or Olympic gold medalist or a top CEO. That's been built over the years. It's never too late. It's just a matter of that small growth on daily basis. Atomic habits type of thing, right? So waking up early is a big one. All the bad things in life happen at nighttime. So the earlier you wake up, the sooner you're going to feel tired and go to sleep. Having great, good diet, having a lot of friends, classic stuff that you've been taught over the years, biblical or otherwise, are always successful, recipe for success. But waking up early, health, gym, surround yourself by great people smarter than yourself, and having a smile on your face.
Yep. Scrolling down to the last question here, because we've really covered the other two already. If you could give one piece of advice, to an aspiring real estate entrepreneur, what would that be?
Yeah, as an advice I would give myself to my younger self would be the disease of shiny object syndrome. And it's with so much information coming at us on social media and other platforms, it's really difficult to stay focused on what is it that we do. But you need to figure out what you believe in, if it's in business or in personal life, and give it your all. Give it your all. There is the matter of sunk cost fallacy in life where, it's a situation where you've given it all, but it no longer makes sense, or that business doesn't even exist anymore. The Kodak moment, if I may, that's fine. You can pivot and you can, move around that situation. But having the conviction, having the focus on one, one business model or one strategy or one goal is probably the most important thing, and not getting distracted. If it's myself with cryptocurrencies that came out, and while I was in real estate, this is probably well over 10 years ago, but rather than just investing in crypto, I wanted to build companies within the crypto world. Not coming from that background, it was very difficult. So that took some time away from real estate. Same thing within the world of real estate. I was a home builder. I described. I love the concept of short-term rental. I think that business is going to continue to grow, but I always have to bring myself back to CPI, our firm, and our investors, my partners, and try to stay focused. So I would say focus is the most important advice I could give to someone, and not getting distracted by different things that come up.
That is well said. And I love acronyms, and my word for the year is focus, and it's follow one course until successful. So thank you so much for being here. It's been a blessing, August, to have you on the show. Point people in the right direction. They want to follow you. They want to learn more about CPI and how they can get engaged.
Yeah, I'm very active on LinkedIn Top Voice, like Logan mentioned. So August Biniaz on LinkedIn, send me a connection request. Happy to connect with you. Our website, cpicapital.com, has a lot of great information. We have our master classes on there that's only accessible through our website. We have our underwriting model, a lot of great information on the knowledge section of our website, a link to our podcast. So yeah, those are a couple of great ways to connect.
Absolutely. And if you guys are interested in talking to ourselves and our team about Kansas City commercial real estate, feel free to go to our website, www.mwcreadvisors.com. We're dropping press releases, insights on a regular basis. You can see all of our listings and opportunities there as well. August, thank you so much. And this has been another episode of the Kansas City Commercial Real Estate Market Pulse. We'll be back live again next week. Thank you for all the listeners tuning in and for your questions. We appreciate it.